Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor. I've got 3.5 million quid worth of property, I've got 1.7 million pounds worth of debt on them. And because of that, what's been said today in the Bank of England policy meeting really matters to me. Because as interest rates rise, I have to pay more on those mortgages, and as I do, the amount of money that I'm making comes down unless I can raise rents by the same amount that the interest rates have gone up. So that's always the ideas for landlords, is as interest rates go up, we try and raise the rents to compensate for that. The market, however, dictates what the rents can be. Let's get into the detail though. Let's go through the report together and understand what's going on, what's been said. There are some glimmers of hope in this report as well, I think it's important to say. And just before we do go through the report, if you haven't already subscribed and you like this sort of content, we don't do any upsell on this channel. In fact, quite the opposite. Why not consider subscribing? We have our subscriber dividend portfolio where every single month we give away the dividends from that to our subscribers. There's about £4,500 in there at the moment, and I'm putting an extra £1,000 in every single month, and we're going to pay that out so that you guys can take part in the passive income journey with me, and hopefully I can inspire more people to become investors for the long term. So here we go guys, let's go through it. I've already been through the data, so some of the bits I'm going to skip past, the things that I think might take a little bit long in this video, and I don't think are that interesting. So you might hear me get through some bits pretty quickly. The headline data straight away, 3.5%. We've gone up by 0.5%. It was widely anticipated that that would happen. But ultimately, what is really interesting is that two people had voted out of 9 to keep it as it is. One person had voted for a 0.75 and the remainder went for 0.5. And what I think we're really starting to see is that there's going to have to be a change of tact, and the interest rates this might well be the last rise we see for a little while. And that's because some of the data that we're going to look at today really is doing exactly what the Bank of England are intending on happening, and therefore we can see the glimmer that inflation's starting to come down. And that is one of the bits of data that they are really looking at. So let's just go through this in a bit more detail together so we can have a look at it. The first section here really is the summary. I'm going to skip through this and just get straight into the data with you. And that's going to start here we are. So UK weighted world GDP. So this is how fast the world economy is growing, increased by 0.5%. Euro area, 0.3%. United States, 0.7%. And obviously energy prices and all that sort of stuff, they've started to come down. You can look at the oil price, it's down by about 15%. It's significantly cheaper. However, gas is up. The real interesting thing here, though, is the inflation in the Eurozone. That's down from 10.6% in October to about 10% today. And USA inflation, i.e. in America, 7.7%, falling to 7.1%. So that again suggests that the Fed is having the desired result. They're bringing inflation under control, and this is really why interest rates are rising, because it takes money out of the economy, and when money comes out of the economy, inflation, price rises, they start to come down as people have to compete more. So we go on to the second section for monetary and financial conditions. Government bonds have gone down, especially over the 10-year. They are down by 20, 60 and 20 basis points for the UK, US and Germany. And this indicates that the market is thinking that interest rates are going to come down in the longer term. And when you get this inverse yield curve, basically what it's saying is, right now we believe interest rates are going to be higher, but later we believe they're going to be lower. It indicates and predicts a recession. Because when we go into a recession, generally speaking, the Bank of England and the Fed and all the monetary policy needs to become more accommodative. And because of that, interest rates come down so people can borrow more and then spend more. So basically what the market is saying is we believe there's going to be a recession in the short term, and we think interest rates are going to have to come down in the long term. But now we get on to the more interesting bit, demand and output in the UK. So the ONS is reporting that in Q3, so last quarter, GDP had fallen by 0.2%. So we have had a contraction in the UK. And if we go down a little bit further, the Bank of England are now suggesting that GDP in Q4 is going to decline by 0.1%, which is a little bit stronger than they had before. So they think it's going to fall a little bit more. And with that fall in GDP, we would enter a technical recession. 2 consecutive quarters of GDP contraction. So we would officially be in a recession after that. Indicators of household consumption remained weak, and is some really interesting stuff about the housing market, which is a lot of people who watch my channel, including myself, is really interested in. I'm going to read this exactly as it's written here. Most housing market indicators have continued to weaken in recent months after several years of strength. Absolutely, we've had really good growth over the last couple of years, in total of around 20%, give or take, depending on where you are in the UK. Although the official UK house price index has increased strongly in October, house prices have fallen quite sharply in Nationwide and Halifax indices in October and November. And there is always this lag factor. It's important to say that, right? There's always a lag from when you negotiate a sale to when it completes to when it comes through in the data. So we know from all the other data, as well as the anecdotal data I'm being told by agents. I mean, we're getting phone calls from agents trying to sell houses, which hasn't been happening for months and months and months. So we know that the market is turning. The November RIC survey had shown further declines in price balances and continuing weakness in indicators in housing marketing activity. According to higher frequency Zoopla data, the volume of offers made on properties by potential buyers had declined now to below their normal seasonal levels. And this really underlines what's going on. People are nervous, people are worried, the cost of borrowing is going up, house prices are coming down. And you would expect this to happen. So with this new rise, with everything that's going to come on, again, there's a lag factor. Not all of my interest rates come up next year. People have fixed term mortgages. Some of mine are 2024, 2025, 2026, even some of them. So there's a lag factor to people like myself who are going to feel the pain. But what it does do for me is mean that any new property I'm purchasing, I have to get it cheaper than I did before if rents are staying roughly where they are. So it's really important to understand that there is two ways to attack this. If rents go up and interest rates go up, then you're in equilibrium and you're still going to make a good profit. But if rents stay the same and interest rates go up, well, house prices, for that deal to be worthwhile, need to come down. And at the moment, we haven't seen big drops. 2.3% last month, which is a significant drop, one of the largest, but it is still 2.3% on the backdrop of 2 years and 20% growth, you know? So in that backdrop, it's quite a small contraction. But I do think it's important to say it's likely to continue as long as interest rates continue to rise. Here's another really key indicator though, supply, costs and prices. The labour force survey, so this is the number of people that are unemployed. The unemployment rate has risen to 3.7% in the 3 months to October, slightly higher than the 3.5% that was expected. Now the key thing with this is, as monetary policy tightens, as businesses spend less on investing, as people spend less on goods, people start to lose their jobs. And when people start to lose their jobs, there are more people looking for jobs. When that happens, guess what? There is more competition for jobs and wages start to contract. So if we look a bit further down, I'm sure they're going to have some data in here. Here we are. Annual whole economy total pay growth had picked up slightly to 6.2%. Private sector pay growth has also picked up to 6.9%, 0.5% percentage points stronger than expectation. That said, you're going to see that start to decline, in my opinion, as soon as this unemployment figures start to increase. And, you know, we're looking backwards on the data, you know. You make these changes 3 months ago, 6 months ago, 12 months ago, and then businesses make decisions today. This decision that was made by the Bank of England today will not have an immediate knock-on effect. You have to wait 2, 3, 4, 5 months, especially with properties, right? Like it takes a month to find one, a month to get the offer through, a month to get all the conveyancing sorted. You're looking at 3 months as an absolute minimum for that to come through as a sale. So let's just consider on all of this that there's such a lag factor that we're looking back in time when we're looking at all this data. So now that unemployment's starting to rise, and I can certainly see that among some anecdotal data I'm hearing from recruiters, that there are more candidates than there has been for a long time, and the number of companies recruiting has started to reduce. You're looking at a perfect storm for wages to have some downward pressure on them. And if you're really looking at crushing inflation, you need downward pressure on wages, downward pressure on demand. Interest rates are doing the job, aren't they? And here we are, 0.35. 12-month consumer price inflation has fallen. And this is the first fall in recent times. It's now down to 10.7%, which is a huge number, don't get me wrong, from 11.1% in October. However, that is lower than they thought. And again, you're looking backwards. Inflation doesn't react immediately to an interest rate rise. So anything that's done today, you're going to have to wait 3 to 6 months to see the effects coming through. It's well known that there's this lag factor. And Andrew Bailey, the Governor of Bank of England, has talked about the fact that they're going to have to start considering the lag factor of what they're doing. So this brings us to the immediate policy decision, point 40, that MPC sets monetary policy to meet the 2% inflation target. And in a way, this is important, I think, in a way that helps sustain growth and employment. Now, both of those two things, growth and employment, are under attack right now. So it is my strong belief that this interest rate rise, it might not be the last one, but I believe we're getting to the end of the tightening. And I think that when we look at the data in the next couple of months, we're going to see unemployment rising, we're going to hear about wages starting to contract, and we're going to hear about inflation coming down much, much faster than maybe has been anticipated. So guys, as a property investor, do I like interest rate rises? Look, I'm a bit apathetic towards it. Ultimately, I need to see what happens with rents. If I can push my rents and interest rates go up, I don't mind. My profit margin will remain the same. However, if I'm going to take on this extra cost and I'm not going to be able to increase the amount of money coming in, then the amount that I want to invest in property in the future is going to contract. And that won't just affect me, it will affect the entire landlord sector. But furthermore, I think that consumers who buy and live in properties are also going to see a contracting market, and they're going to start to delay purchases as well, which will further exacerbate things. And let's face it, nobody wants to be presiding over a country where ultimately the wealth is going down at a sustained rate. Property prices in the UK have a very significant proportion of the UK's wealth tied up in it. So it's in nobody's interest to see this go down significantly and quickly. But guys, let me know what your thoughts are. Me, I was expecting this 3.5%, exactly where I thought it would be. Do I like interest rate rises? Look, on face value, most people would be quite negative about it, right? We're taking money out of the economy. But with all of these things comes opportunity. And property is one of those sectors where actually the more scared people become, the more opportunity you have to strike a deal. It's not like stocks and shares where they react really quickly and you can't market make. With property, you can negotiate. And that's the beauty of this investment vehicle. You can negotiate with a seller and you can get a cracking deal. And only when there's a large amount of pessimism is that available for you. The last 2 years have shown us when it's on an upward trajectory, the buyers have very little strength. In fact, they're just buying at market rate. But when the market starts to come down, it gives you a huge opportunity to make big chunks of cash in a small period of time. Let me know your thoughts in the comments down below. I hope you appreciate us putting this together at such short notice. Like and subscribe as always, and I'll see you on the next video. Cheers guys.